I'm seeing a lot of videos on YouTube and a lot of posts on X claiming that we're in a market bubble, and I'm getting a lot of questions. If this is a market bubble, if this is 1999, if this is 2021, if this is some kind of a major stock market bubble. So I decided to go through this list again, and this is mainly a list that kind of marks common signs of a top and common signs of a bottom. Back in 2021, I went through this list, and the top signs, we pretty much ticked every single one of them. So I'm gonna do something fun in this video. I'm gonna go through every single one, talk about them, tell you where we are relative to this sign, and if I believe we are there or not, and just talk about the market in general. So I really hope you enjoy it as always. Now, the first one is a large number of IPOs. This is a major top signs. In 2021, we had a lot of IPOs, but mainly SPACs, special merger acquisition companies. 1999 was crazy in terms of IPOs. Right now, we don't have a lot of IPOs, but we have SpaceX. They're trying to IPO. Next month, you have Anduril potentially coming up very soon. You have, I believe, Anthropic coming up. You have OpenAI coming up. You have a lot of companies coming up in terms of IPOs over the next few months. Now, why is IPO such a sign of a major top, or such just a euphoric sign? And this is because the insiders believe that they're seeing enough buyers, enough euphoria, enough willing buyers for them to get the highest exit possible. This is why most companies IPO, because they're looking for an exit. And in most of the time, you're the one that's their exit liquidity if you're buying an IPO, and they're seeing the market for it. No company is going to IPO when there's a lot of pessimism, and whenever people are conservative, and whenever they believe they can't get a bubble-like valuation, whenever they believe they get, I don't know, 2 times sales or 10 times earnings or 20 times earnings. They're only going to IPO when they see the market for getting the highest price possible. And that normally happens in euphoric markets. This is why Warren Buffett says he doesn't buy IPOs, because whenever you buy an IPO, you're pretty much giving them the time to sell to you. You have no say. They're picking the time to sell to you. But if you're buying any other stock, you're picking the time to buy from them. This is a completely different setup. So this is why IPOs are such crucial in terms of identifying a market top or a major top or a bubble in general. We're not there yet, but it's coming up over the next few months. The second one is rapidly rising prices. You could say we have some of that. If you look at the semiconductor ETF, I would categorize it as rapidly rising prices. If you look at EWY, the semiconductor ETF in South Korea, or even the South Korean ETF, but most of it is semiconductors. You know, Samsung and SK Hynix and so many different companies, mainly semiconductors. I personally seeing a lot of rapidly rising prices. And of course, there's a justification for it because AI is the future and AI grows and the earnings grows. But there's always something to justify rapidly rising prices, or else people wouldn't be buying. You know, in 2021, there were also reasons to justify rapidly rising prices. We had, you know, a lot of things within EV stocks and things mainly around climate change. In 1999, we had the dot-com, and we had, I believe, earnings growth of 30% on the S&P 500. So the fundamentals actually looked great, but the price of these fundamentals, the deviation and expectations were so high that it ultimately ended up being a bubble. But there's always a reason to justify something going up. It always, like you say, this time is different, but most of the time it's not really different. But in terms of rising prices, I'm seeing rising prices. But the thing is, I'm not seeing it everywhere. I'm seeing it in semiconductors, other stocks, Moody's, S&P Global, other amazing companies. I'm seeing falling prices. Number 3 is excess leverage. This is a really big one. If you look at the margin debt right now, as a percentage of GDP, it's 5%. So 5% of GDP is in margin. So people are taking on margin because they want to bet on the markets, they're buying the leveraged ETFs, and they're taking on loans just to put it in stocks. This is a massive sign of euphoria. But my favorite sign is the year-on-year percentage change of the FINRA margin debt. Once it reaches about 60%, if you look at this slide, 60% year over year increase, that normally tends to, okay, you could say, mark a major top. That happened back in April. You could see it, April of 2021. We went over 60%, and that was a sign of a major top. It happened before 2008, happened even in 2000, before we topped and before the market started crashing. You had massive euphoria, and people were so euphoric that they were taking on margin much more than they did last year for them to go out and gamble in stocks. So this is a major sign. We're not at 60% yet, but we're also getting there. And it's important to remember that this is not a timely indicator. For example, we reached it in April, but the market topped in December. So once you have that margin debt, you have this euphoria, it feeds on itself, and more people do it, and it brings on more euphoria. So it's not like if margin debt reaches 60%, that means, oh, we're topping out today. It could go on for another 5, 6, 7, 8 months, and you could have one of the best returns you've ever seen in your life. So it's a little bit tricky. But in terms of bubble territory, we're not there yet in terms of excess leverage, but I believe we are getting there. Number 4, the availability of credit. We don't really have a lot of availability of credit. We have, you could say, the quantitative easing, which I believe was 5 billion a week, but it's gonna stop. So we don't have like lower interest rates and a lot of excess liquidity in the system, or we do have excess liquidity from COVID, but we don't have like cheap money, cheap credit. We don't have none of that right now. Number 5, over optimistic front covers of newspapers and magazines. I'm personally starting to see some of it, but not really a lot. I'm seeing some of it on CNBC, but still, I think there's still some skepticism, and there's still some people calling bubbles and calling things overvalued. And normally, market pullbacks don't really happen once you have a lot of people calling something a bubble. It normally happens when people believe this time is different and things will keep on going forever. Number 6, very high trading volume. We have a lot of it right now, especially in zero DTE options, 0 day to expiry. 60% of S&P 500 options are 0 day to expiry. There's a lot of trading volumes on semiconductors and other kind of asset classes. So there's definitely a very high trading volume. Number 7, historically high PE and enterprise to EBITDA multiples. We definitely have a higher PE ratio than normal. We're trading at about 21 times. The average is like 17, 16 times. The PE tends to contract in a major way during drawdowns. That hasn't happened this time. We barely got to 19 times earnings, and we're trading at 21 times. And that's, again, on a forward PE. It's not using chiller or nothing else that other people like to use. So in terms of multiples, I believe we're definitely up there. Number 8, art and luxury markets booming. I'm not seeing a lot of that. I'm still seeing, I'm not seeing none of that too much. Number 9, which most of those are the same. Number 9, financial press and financial TV becomes favorites. I'm seeing more of that. I'm seeing more people watch CNBC, watching Bloomberg, following those things on social media. A lot of those creators are popping up like crazy around financial stuff and TikTok and on Instagram and all of that. And that normally, again, doesn't happen whenever, there's a lot of, you could say, conservatism or the market's going down. It tends to happen whenever there's more euphoria. Number 10, this time is different declared. I'm personally starting to see it, but I'm not seeing it yet. I'm seeing more people are saying this time is different. This is it. This is AI boom. We have the earnings growth. Look at those earnings. Look at the 8 PE multiple on Micron, even though Micron traded at an 8 PE multiple forever. And you have to also understand how sustainable is the earning power of Micron, and when will those things actually be solved? Because if memory prices decline, Micron will not be trading at 8 PE. It would be trading at 15 or 17 or 20 PE, and it would have been a trap just like it was over the last 20 years. And the people that bought it because the PE was low, they pretty much lost their short. So there's way more to it than just a stock trading at 8 PE. But again, I'm seeing this time is different, and semiconductors, and people are even telling me that we will never crash again because the administration is supporting the market. So I'm seeing some of it, but I'm not seeing a lot of it, not as much as I would have expected, and not as much as I would have seen before. Number 11, immature investors move to the equity asset classes, meaning more and more new investors start to join the market. I'm not seeing a lot of that. but I'm starting to see some of it. I'm seeing more people, hearing other people getting rich on SK Hynix or some kind of a memory stock, and they're getting tempted to enter the market, start to pick individual stocks. Now, what normally happens is they start picking those stocks, and once we have a market crash and they buy the dip and those stocks go down 50, 60%, then they give up and they move to index funds. This is what happens to most investors, unfortunately. But I'm seeing some of it, but I'm not seeing a lot of it yet. 11 and 12 are pretty much the same. And I believe there's some of it. I'm seeing a lot of overconfidence from investors, people that traded the memory stocks or, things around the AI, and they believe, they're the best thing ever, and they believe they can do it over and over and over again. And maybe they were smart, maybe they did the right thing, but maybe they were in the right stocks at the right time by luck. And maybe those things are not going to always happen again, especially once we don't have this euphoric time that we have right now. So I'm definitely seeing massive, massive overconfidence. So based on this list, to be honest, I don't believe we are in a stock market bubble. I think we're entering a bubble. I think the bubble is forming more and more. But in terms of a clear market bubble, I'm personally not seeing it. But I'm seeing some risks that I want to highlight, and I highlighted in my previous video. One of them is the inflation rate. Now it's about 3.8% on the CPI. This is much, much higher than what the Fed was expecting. Now, most of it was due to energy. It's a 17% increase in energy prices. That drove most of the CPI much higher, and this increase in energy is starting to drive food prices a little bit higher, is starting to drive other prices higher in general, and that's normally not a problem if energy prices are not going to remain high forever. And that was the case over the last few weeks. But as of recently, if you look at the oil futures curve, it's starting to price in higher oil prices for longer. For example, even for the December rate on the future curve, even if the war ends, you could say, it's pricing in oil at about $83 to $85 per barrel, not at 50 or 60 or 65 where we were not long ago. It's pricing in $85 per barrel. So even, you could say, if the war ends and everything goes well, traders are starting to price in higher oil for longer, which ultimately could hurt the sustainability of the CPI being at 3.4, 3.6%, and that would not be good at all. The 30-year yield is also sniffing it. It's trading at 5.12%. 5% on the 30-year is extremely, extremely high. Then you have the 10-year, which is also exploding at 4.5%, 4.6%. This is not good for semiconductors. It's not good for the growth stocks. It's not good for any company that doesn't generate a lot of free cash flow in the present, but it's all about the future and future profitability and future cash flows. It gets discounted at a higher rate, which is why those stocks tend to suffer. As the money rotates in insurance, it rotates into a lot of companies that have a very high free cash flow yield or that generate a lot of cash in the present. Now, I'm seeing a lot of comparisons of the 10-year at 4.6 and the S&P 500's earnings yield at 3% and claiming that this is a bubble because that means the S&P is overvalued. Now, I'm not arguing this point, but the 10-year yield, yes, it's above the yield of the S&P, but the 10-year is not growing. The S&P 500 is growing in earnings. The 10-year is not growing. So the 10-year should be a little bit more than the earnings yield of the S&P 500. I don't believe this is, I think this is common sense. But I'm seeing a lot of people making this comparison and saying that because the 10-year is above the earnings yield of the S&P, that means the S&P is overvalued. But the 10-year is fixed and the S&P is growing, so you have to put in some premium on the growth. And I think this is what we have here. So again, I'm not seeing the bubble territory, but I'm seeing a lot of risks in the near term. I also highlighted this chart of the S&P 500 and this trend line. It pretty much reached the trend line and it rejected it. This is a nasty rejection. We're entering the Fed meeting, I believe, in June 11, June 12th of next month. You have a new Fed chairman. You have some uncertainty. You have a lot of new things that could happen. So this is why I'm personally seeing potential weakness in the short term. And this is why I said in my video, stock market could crash next month. It wasn't clickbait. I gave you a lot of reasons and things around the Fed chairman. To me, it's looking more and more likely, but we'll see what happens. And after that, I think we could potentially do really well. And I'm not seeing a market bubble yet. I think we're getting there. Like if it continues on, and then the Fed chairman is extremely dovish, and it fuels the bubble even more. I think we could have a bubble, and it could last a few months, and maybe we could go down then in 2027. But in terms of a lot of the signs, margin debt is getting really, really scary, is approaching the 60%. There's more euphoria. The IPOs are coming up. And again, once those things happen with margin debt and IPOs, it tends to go for another 5 6 months before we reach peak euphoria, and we go down. And I'm not saying we go down 5 or 8%, which what we're used to. Normally, after such major tops, we tend to go down 20, 25, maybe 30%. And again, I'm not trying to time the market. I'm not predicting. I'm just looking at data and speaking from experience and talking about the market in general. But I don't believe we're in a bubble. I think we're getting there. And that was just my opinion on the market. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.